Let's go. If he's hitting on the desk, that means it's the start of the show. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. I promise you, folks, this is not a green screen. This is real. It is Thursday, December 15th. I did have to check because, I don't know, time is a flat circle. Nothing makes sense. I also don't know how it's already the heart of the holiday shopping season. But you know that it is the holiday season because there are holiday lights here on the floor. I'm your host, JD Durkin. A lot to get to today. Of course, taking a look here at the major averages in terms of pre-market contracts. It did indicate that the major market indexes would be closing down today. No big surprise if you had followed the afternoon seesaw that we got at the end of yesterday's trading session after the Federal Reserve made it official. Everything that we thought they were going to make official, 50 basis points. The problem, however, for investors is how high the federal funds rate is going to go and how long it will stay there for. Let's take a look at what is on tap for this morning's broadcast. We will, of course, talk about the number one story in the world of business the last 24 hours, which is the chairman of the central bank, Mr. Jerome Powell, his remarks, the statement, and then, of course, the carefully watched and always carefully dissected question and answer with reporters there in the room. We'll also talk about is it Musk? Am I pronouncing that correctly? I think I am. Elon Musk unloads more Tesla shares, making a bit of a promise here to Tesla shareholders who might be concerned about the Twitter dilemma. Dilemma's one word for it. And finally, we'll talk about TikTok. As more and more lawmakers, it's not just Republicans, I gotta say. There are increasingly concerns for Democrats as well, both at the state level for state legislatures across the country, as well as members of the U.S. Congress. For more insight into those stories and so much more, let's bring in our chief markets correspondent, the man of the hour. He's always the man of the hour, Mr. Martin Baccardax. Martin, good morning. I hope you got some rest last night, because knowing you, I feel like you were vigorously digging into all of the Powell-related data yesterday. But let me get what is your top of mind. I mean, to me, it seems as if on the surface, in the short term, I feel like this is what people wanted, right? We wanted to see a loosening of monetary policy. We wanted to see 50 basis points. But to me, Martin, it seemed as if the real concern came with, we talk about the dot plot. Where is this thing going to wind up? And if it's more than 5%, that's certainly quite a bit higher than investors had previously hoped for. But what stood out to you in yesterday's session as we saw investors ultimately take some profits as the day ended?
Yeah, I think ultimately, JD, the takeaway that I at least received from yesterday's events was the fact that we anticipated that Powell was going to play spoiler, and that's precisely what he did. The market had been rallying for 2 or 3 days prior to the Fed decision on the assumption that the softer November inflation and weakening data in other economic areas around the country would compel the Fed to not only slow the pace of its rate hikes, but indicate that it may at least take its foot off the gas relatively soon in order to assess the impact of their cumulative tightening and to look at the data going into the start of next year. It doesn't appear that the Fed wants to do that. Powell appeared to echo the views of his colleagues in saying that they're a long way from taming inflation. They've got a lot of work to do. They're going to have to increase interest rates probably by another 0.75 of a percentage point between now and the springtime, and they're going to have to stay there probably until the end of the year. They see still highly elevated levels of inflation into 2023. They see lower levels of growth, and they see rising unemployment. Now, that's a toxic mix because those figures don't necessarily point to the kind of tightening that the Fed is looking to execute, because they're also selling bonds from the balance sheet at the same time. So the market was caught off guard by the hawkish tenor of not only the statement, but the Q&A that followed with the media at 2:30 in Washington. And that's a big part of the reason we had the sell-off yesterday, and it's accelerating again today as people pick through the details. There's very little that you can find that would offer solace to investors who are looking for some kind of pause, pivot, or change in tone, or however you'd like to describe it from the Fed. It was far more hawkish than anticipated. I think needlessly so, but nonetheless, I'm not the person in charge and tasked with making these very difficult decisions. The market absolutely has to react to it, and that's what they're doing today.
Stop me if you've heard this before, Martin. The historical record strongly argues against loosening policy prematurely, and we will stay the course until the job is done. We heard that again yesterday, and we also heard that from the man when he spoke at Brookings not that long ago. We also heard that from him verbatim, quite literally verbatim, when he spoke in November. What does that tell you? I feel like that's been one of those things that gets most frequently written about in Jay Powell's previous public statements. And it seems very intentional that he would come out. And for people looking for a little bit of a, not a Fed pivot overall, but a slight pivot on language, I don't get the sense that they necessarily got that. But was there more that he maybe gave that maybe I missed to make people say, okay, well, that's at least kind of different phrasing this time?
Not that I could find. I think he doubled down to some degree. You could argue that he is, at the very least, maybe just trying to cement the Fed's credibility after the disaster of last year, in which he described inflation as transitory, and all it did was accelerate beyond that. We're in a different situation now as a result of what's obviously the loosening of COVID restrictions in China, the opening up of supply chains, and sort of the lack of headwinds from that regard, and with respect to how they would influence U.S. inflation rates. And the arithmetic it's there for all to see. We've had 5 consecutive months of decline for headline inflation that is going to continue into next year as a result of the measurement period. So I'm not entirely sure, and I don't think a lot of analysts are either, as to why the Fed chose this time to increase the hawkish rhetoric when it seemed in late October and early November that they were at least exploring the idea of, if not a pause, at least a slowing and a more reflective approach to monetary policy. So this is indeed a little bit mystifying. Every assumption seems to point to the fact that inflation is going to slow. Data this morning seems to suggest that the economy is actually slowing more significantly than we had hoped as a result of a pullback in consumer spending, which is the driving force of growth here in the world's biggest economy. So the Fed is now putting itself into a position where it may be hiking into a recession, and I just don't see that as tenable.
I do want to pop in just to give a quick market update to give people a sense on the sell-off we're looking at currently. I mean, we're only 7 minutes into the trading session here, and you can still see people who are watching here. I mean, we've got a ton of people here on the floor, and obviously it's always a very celebratory moment when a special group is here to ring the bell. But it's on the backdrop of the big board with a lot of red. The NASDAQ down 1.8, the S&P is down 1.5, the Dow down 1.3. Give me a sense on anything else that is top of mind for you. Are you surprised to see that sort of pullback a day later? And has there been, new information? I know we talked about retail sales there briefly a moment ago. Anything else top of mind you think for investors into this trading Thursday? This is certainly not the reaction that people had wanted, but granted, it's not necessarily the information they wanted to hear yesterday.
No, precisely. I think essentially you have a combination of factors this morning. Obviously, you're going to accelerate the sell-off from yesterday if you pick through the details and don't find anything that would change your opinion established after the first hour or so from the press conference. So that tends to be the playbook in these situations. But this morning, of course, you have those November retail sales figures, which show not only a decline at the headline level, but a decline in the control group measure. And that's meant to strip away not only energy, gasoline, and auto prices, but also vagaries in the measurements. That is really meant to be the more established figure in understanding consumer spending strength. And that's the weakest in about 11 months. And I think the first decline since 2021. So that's really significant. You had weaker than expected industrial output this morning as well. And of course, you have central bank tightening in Europe at the same time. Collectively, it seems investors are looking at the difference between what it is that central banks are seeing and how they are reacting compared to how companies are reacting. And I think the most explicit demonstration of this, JD, is where we are with respect to borrowing rates. In other words, Treasury bond yields are pointing to recession, but corporate bond yields are actually pointing to value, particularly in companies that are able to pass on price increases to their customers. And that probably, of course, I would say probably, it will engender at least some confidence that companies can navigate this situation a little bit more adeptly. But nonetheless, that difference, I think, is interesting and may be reflective in what the Fed is trying to do, and that is to maintain its inflation-fighting stance, even though there's differing opinion as to what's going to happen to the broader economy and how it will affect stocks and companies. The most important number of all this morning, JD, I think might be a reflection as well as to what Mr. Powell was talking about yesterday during the press conference. He made several references to the strength of the job market, the fact that there was such high demand for labor, and it wasn't being met by the workforce because there are so many people sitting on the sidelines. And that, of course, was lifting wage growth. And wage growth feeds into one of the most important buckets of inflation measurement that the Fed relies upon. Jobless claims today fell by 20,000. There were 20,000 fewer applications for new jobless benefits. It came down to about 211,000. And I think that's the lowest, or close to one of the lowest numbers in the last 6 to 8 months. The 4-week average was also down, and continuing claims didn't really move at all. So if there is one piece of information that Mr. Powell can cling to today against the market reaction, it's the fact that the job market remains so tight and so robust that he is justified in worrying that wage pressures are going to continue to feed into inflation. But that's really the only bit of news that he can look to as supporting his position, because everything else that we're seeing is moving in the other direction.
Yeah, where are the workers? We've asked that before with regards to that big discrepancy. And you're right, and we've heard this because an important part of these press conferences is before he gets to the Q&A. And we talked about this yesterday. He kind of gives it's sort of like a state of the economy, right? The president comes out once a year and does a State of the Union. The chairman of the Federal Reserve does a broad strokes view of the economy. It's actually a pretty interesting part of the event to listen to. One of the questions that Chairman Powell was asked was about you call it the pace of rate hikes into next year. I think the next FOMC meeting here is early February, I think February 1st, February 2nd or so. And I think he was asked specifically, what are we looking at in terms of 25 basis points moving forward? What indication did we get from the chairman of the Federal Reserve? Knowing that there are going to be more rate hikes, I think at this point that's pretty clear. But I think the pace will be important to investors, even though Powell himself has said the pace is much less important, in his words, not mine, than the terminal rate and how long they stay there for.
Yeah. The indication, I think, at least as expressed by the CME Group FedWatch, which tracks Fed funds trading, is that the 25 basis point rate hike in February is baked in, at least at the moment. We've got a lot to get through between then and now, of course, with respect to inflation reports, jobs reports, and the first prognostications with respect to earnings from the fourth quarter reporting season. So much can change, but I think we're hovering around the 70% percentile in terms of probability for a 25 basis point rate hike. We'll probably get another 25 after that, but that's where we begin to see the split from the trader's perspective as to whether they think the Fed is going to hold at 5% or just below, and for how long. I'm still seeing the prospect of rate cuts in the latter part of next year, even against what Mr. Powell said last night when he indicated that they weren't even thinking about rate cuts at this point, and warned, as you alluded to earlier, about the historical record cautioning against premature loosening. So it's interesting now, JD, we do seem to have a trade. We have the bond market challenging Mr. Powell's consensus. In other words, they're calling him out and saying that his hawkish rhetoric and tone and projections are simply not being borne out by economic data, and they are trading against it. And they are betting on rate cuts at the end of the year. And of course, we're continuing to see bond markets flash deeper recession signals as a result. Now, I thought it was curious that Mr. Powell talked about the fact that the labor market remains robust because the Fed hasn't made enough progress in fighting inflation, and perhaps didn't raise rates high enough. It's a paradoxical view, but nonetheless, it's one that we probably should pay attention to. If he continues to focus on the labor market, I don't think there's any doubt as to how and when he's going to take the terminal Fed funds rate to 5%. What happens beyond that is the real question of the moment.
Unemployment currently sits at 3.7%. Fed officials expect that rate to rise to 4.6% by the end of next year. It's kind of one of those counterintuitive things that the central bank wants to do. What do you always call it? The grim science, the dismal science? You use one of those two phrases really well. The dismal science here, an kind of intentional increase in unemployment. Do we have a sense on how many people that is? That's what I've legitimately wondered. I just don't know the answer, and if I don't know it, I assume some viewers may not know it. Do we know exactly what, like, 1%, a full percent increase in unemployment is X number of jobs? I mean, either way, we're still looking at likely 100,000, hundreds of thousands of jobs, 500,000 more jobs that could be lost if this
Yes,
if
no
this
question.
tightening
It
cycle
would be
continues. I feel like that writes
percentage
about right,
point
right?
increase as opposed to a percentage
A
increase,
point.
but
Yes,
nonetheless, it's
yes, yes.
still
Thank you.
significant. The best way I think to look at it, JD, is the fact that we're basically now creating about 272,000 new jobs per month, and that's basic if we look at the last 3 or 4 months of job generation. But we are starting to see headlines that indicate layoffs, although companies are reluctant to do it too quickly because they're worried about having to hire back and how expensive that might be. But you can see those numbers leveling off into next year. The pure calculation is, of course, complicated by the fact that there are so many people sitting on the sidelines already. So it might be an exchange of labor rather than a complete loss of jobs. But to get to that 4.6% unemployment level that the Fed is talking about, at least most economists say it's almost impossible to do that without recession. That's such a change in the headline employment rate that it simply wouldn't be possible, whilst also engineering the soft landing that Mr. Powell said last night he is still hoping to execute. So that one's going to be worth watching.
The 10-year Treasury yield dipped below 3.5%. Help us better understand that particular reaction to the Fed's decision yesterday with a little bit of context about what that means.
Essentially, the best way to think about it, or at least the way that makes most sense to me, is that you look at shorter term bond yields as a sort of vessel in which traders can indicate their concern for interest rates. In other words, they're most sensitive to interest rate movements, whereas longer term bonds are more sensitive to growth forecasts. So in this situation, you have 2-year Treasury note yields rising a little bit, simply on the assumption that we're going to have higher than anticipated Fed funds rates, and therefore that's going to cause a corresponding rise in 2-year Treasury bond yields. But at the same time, they're concerned about near-term growth forecasts. They see that decline in retail sales, they see that pullback in industrial production, and they're seeing other measurements that indicate economic weakness as well. And therefore, as a defensive mechanism, they'll buy 10-year Treasury bonds, and that will move the rate down because, of course, they move inversely. And that's where you get, JD, this inversion of the yield curve. Traders more worried about interest rate hikes in the short term and more concerned about growth in the long term. And when you have that disparity, a San Francisco Fed research paper has said that that is the most accurate indicator of near-term recession. It's not fail-safe. It's actually missed on a couple of occasions, but it's the best warning signal that we have with respect to an upcoming recession, and it's been inverted since the early spring.
I'd like to ask you just briefly about the updates out of the Bank of England. Seems as if we got our two central banks, on a similar timeline here. Obviously, we had the news here stateside yesterday. Bank of England raising rates by 50 basis points, saying it will continue to do so forcefully, quote, forcefully, if needed. Any perspective or anything top of mind for you think people should know as they wake up and see those headlines?
That's a difficult one. The Bank of England is hiking into recession, absolutely. And of course, the economy there is pinned to the wall on the basis of a whole bunch of moving parts, the government's budget crisis over the summertime, the political instability that the leading government still is working underneath, the implications of Brexit and the impact it's had on growth prospects and growth potential for what has to be remembered as the 5th largest economy in the world, and a looming energy crisis where prices are moving well out of control for most ordinary citizens heading into the coldest months of the year and indeed beyond. So the Bank of England has a ridiculously complicated task of trying to slow inflation, which is right around the 10% mark, while ensuring, or at least attempting, not to exacerbate the already weakened condition of the economy. I don't know how they're going to thread that needle, and this is going to be an incredibly challenging winter for the UK economy. The ECB also raised its benchmark lending rate, as well as its 2 other key rates this morning. We had hawkish language as well from Christine Lagarde, who is the ECB president. And the indication there is that she is willing, and please give me some leeway with this, because I don't think this is the intention, but she appears willing to sacrifice near-term growth in order to slow inflation, which is running at about a 10% rate and near to the highest levels in history for the economic bloc. It's worth noting the ECB has a different remit to most central banks around the world. Most central banks have to look at both price stability and employment, and indeed, in some cases, economic stability in order to fulfill what they've been tasked by lawmakers. The ECB only has one needle, and that's price stability. So they can afford to be a little bit more sort of casual about the implications for jobs and growth. They absolutely, by law, have to focus on only inflation, and that's why we're getting that hawkish rhetoric from the ECB today.
All right, let's pivot now and talk Tesla, that company weighing on the market this morning. Actually, let's do this in real time. What's Tesla stock doing at the moment? It is up 2%, but of course, that's simply on the day. Year to date, the stock is down 59.9%. Can you give me an update here with regards to that company, what Elon Musk has now said, and how is Twitter involved?
Yes, indeed, it's always involved, isn't it? Dan Ives, who is a noted analyst at Wedbush and has really one of the foremost experts on Tesla stock, has effectively described Elon Musk's use of Tesla share sales as an ATM from which he can extract cash to support his Twitter investment. That's a cold calculus, but it does certainly seem indeed accurate. Last night, SEC filings showed that Elon Musk sold 3.6 billion worth of shares, about 22 million Tesla shares over the first 3 days of the week. And that brings his year-to-date sale total to around $40 billion. If you were to run the slide rule down that, JD, you'd probably see that he has earned more by selling Tesla shares than Tesla has ever earned making cars in its, 15-year history. That's a pretty stark reflection of what's happening right now. He is, of course, having to satisfy lenders who provided about $13 billion in financing for the Twitter acquisition. He's trying to make Twitter profitable despite a pullback in ad spending and all sorts of questions about user safety, about censorship, about shadow banning and malevolent content on the platform. And he's trying to do all this whilst at the same time Tesla is facing headwinds with respect to production abilities in China, demand in the world's biggest car market, and indeed just a pullback in spending that was reflected in retail sales today. This is a really, really challenging period for anyone, let alone somebody who's trying to run 3 or 4 companies at the same time.
Let's pull out this Elon Musk tweet. We alluded to it here a moment ago. I believe our producers have it locked and loaded. That's how we go. All right, he says, I'll make sure Tesla shareholders benefit from Twitter long-term. Are the Tesla bulls losing patience at this point? You talked about Dan Ives. I mean, we love Dan Ives. I always watch him every time he's on.
Yeah.
I mean, what are we to make of this?
No, Dan is excellent, and he has his finger on the pulse in a way that I think a lot of other analysts don't, because he is willing to use a little bit of his intuition above and beyond just simply looking at the numbers on the spreadsheet. But I simply don't. This is a tweet that probably has as much value as an FTT token, to be perfectly honest, JD. It means nothing, and the fact that he thinks he is going to make Tesla shareholders benefit from what he's doing with Twitter just has absolutely no basis in fact, and I shouldn't imagine no basis in future either. You're talking about an attempt to deliver between $600 and $700 billion worth of value back to Tesla investors, because that's what's been shedded over the past 52 weeks. The stock is trading at a 2-year low, and it's suffering its biggest peak to trough decline on record. If Mr. Musk feels that he can somehow redress that for long-suffering Tesla shareholders, well, I think they deserve a little bit more than 22 characters in a tweet.
Very well said. Way to rope in a different conversation that's also very important here. Actually, let's go there. Let's go right to FTX. Well, yeah, I mean, at this point, it is one of the most remarkable stories. And I know it is because I was out with my buddies from college the other night, and a handful of them are not so into the world of day-to-day breaking business news, just kind of have a loose familiarity, as many Americans do. We're the unfortunate ones who have to live and breathe the world of Twitter and news every day. And even all my friends are sitting there just flabbergasted. And I was really kind of surprised with the intricate details with which they understood the FTX saga. And it was like really blowing everyone's mind. So I think it has now kind of crossed over into more generalized knowledge bases across the country, and that kind of underscores what it is. We did learn that Ryan Salami, an FTX executive, tipped off authorities in the Bahamas about some of SBF's misdeeds. Either that or are there any other newly emerging details that most shock you? And I feel like this is the type of thing we kind of hit on now every day, because We said weeks ago this would be a drip, 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 Martin.
Yes, absolutely. I was struck by that story as well. I actually, JD, you'll probably giggle at this. I had to, I had to use a little bit of restraint this morning because whilst I wanted to read the FTX story and delve into the details, I kept saying to myself, you have to look at the markets first. Don't indulge yourself on something that's not going to take you very far forward. You've got to actually do what your bosses would like you to do. But I was fascinated by that reading because it suggested to me that if somebody within the company is willing to flip, if you will, on Sam Bankman-Fried, you can imagine this is going to have a domino effect with respect to the DOJ's investigation into the collapse, the SEC charges, and everyone else. Because it would be difficult for me to believe that colleagues would be prepared to go to prison in order to protect Sam Bankman-Fried, who, it's worth remembering, threw some of his colleagues under the bus after the company filed for bankruptcy in early November. So it doesn't appear that there's much honor amongst them, and the fact that a senior executive was willing to tip off authorities is probably a good thing from a whistleblowing perspective, but also indicative of where this story is going to go.
I like that you use the phrase, no honor amongst them. That phrase usually has a slightly different word used at the end, which I take notes. I at this point, I recognize how you are a very highbrow, incredibly smart, very subtle individual, and I caught that there at the end. No honor amongst them. Oftentimes a different T word used in place there.
I'll leave the interpretation
Sam
to our audience, who I'm sure are just as intelligent.
Absolutely. You all can read the tea leaves here. I'm just helping throw up the alley-oop. You all can slam it down. Sam Bankman-Fried has fought extradition to the United States, but we have heard reports in the last 24 hours or so of these really shocking conditions, reportedly inside this particular, I believe it's called Fox Hill, this particular facility that we know Bankman-Fried is in. Is there any sense that maybe this changes his calculus about now saying, hey, maybe I actually do want to go back to the United States, given his condition?
I would certainly think so, JD. As much as you would like to avoid a situation of extradition, particularly in a circumstance like this, I can't imagine that you'd want to do it in a country that has not a terrific reputation, at least by external analysis, for keeping its prisoners safe, for keeping them healthy, and for providing them the fullest protection that they would require. So I do believe this will change the thought process. I'm actually, from the beginning, JD, I didn't anticipate that Bankman-Fried would fight that extradition too hard. I just don't see it as beneficial in the long run. I think ultimately his best legal tact is probably going to be just the most significant mea culpa that you can imagine, and a promise to work with authorities to claw back as much, if it's possible, of the losses for FTX customers and investors, and also to explain the tentacles that exist between FTX and these other trading platforms around the world in a way that lawmakers and prosecutors can get their arms around and understand it in a better way that they do now. Because at present, the regulations, it's clear, are simply not working. And as a result, they need somebody to walk them through the weeds. I think Bankman-Fried could do himself a tremendous benefit by cooperating with authorities rather than fighting extradition. And I think the fact that he's sitting in a prison that you and I would probably, or I'll speak for myself, wouldn't want to last more than a few hours, probably accelerates that process.
Yeah, that applies to me as well. I'm just going to be clear. You can add me to that category. I appreciate you're like, I'm not going to speak on behalf of JD, but no, we're in good territory here. Okay, let's move here to TikTok with our abs. Yeah, there's no doubt. Let's pivot here to TikTok. We did get this warning from FBI Director Christopher Wray, as many have said, which is as the details of the ByteDance Chinese government relationship, I don't want to say come more into focus. I think that's part of the problem, is that it doesn't come more into focus after all these many years and months. But Christopher Wray, to give an indication, perhaps it is being used as a bit of a spying tool for the Chinese government here. Now you've got this issue being taken up far more seriously by members of Congress, Martin. What is the latest here, and what is your view? And I guess actually, let me first say, I don't know that I know. Are you on TikTok?
I do actually use it, and I find it entertaining. I think as a social media app, it's reasonably compelling. I think it has some terrific features and ease of use and of course, breadth of audience and all those other things. But there is a troubling issue with respect to the data and the fact that it's owned by a China-based company. And I think lawmakers have a point when they say they're uncomfortable about the data gathering and the expansion of the app in the United States when that company is so closely connected to the Chinese Communist Party. Now, that's a phrase, Chinese Communist Party, that is, of course, has loaded context in the US political space. But nonetheless, it doesn't make the concern any less valid. Last night, Senate lawmakers voted to ban the use of TikTok, at least on federal servers. If you're a federal employee and you have a phone that is tied to the server or issued to you by your bosses, you simply can't download the app any longer. Whether that's the step that's in the direction towards a broader ban is difficult to say, but there's absolutely legislation out there, just a few days old, that described TikTok as digital fentanyl, which I thought was an interesting phrase, and they want it banned as a result. And furthermore, JD, they want social media companies that have ties to countries of concern, as they describe it, banned in the US as well. This would give, obviously, an immediate benefit to people like Snap and to Meta, but it would also take away a really popular app that has expanded quite quickly here in the United States. But to illustrate how slow these things move, JD, it's worth remembering that the Committee on Foreign Investment in the United States, it's better known as CFIUS, has been in discussions with ByteDance, which is the ultimate owner of TikTok, for at least 2 years now, in trying to get ByteDance to separate its US operations and allow it to operate under sort of data protection rules here that don't apply to other countries around the world. ByteDance has said it's happy to do so, but the two have been locked in negotiations for at least 24 months now to get that completed. So simply banning something is probably a blunt instrument that won't have the desired effect. But at the same time, it's fair to say that progress comes very, very slowly in an industry that brags and boasts incessantly about its speed.
And through an investigation through CFIUS, if I'm not mistaken, and my memory of this chapter of politics is correct, it would actually empower the president of the United States to make that recommendation, to almost compel that a company essentially cease to do business, or he can sort of single-handedly impose a lot of restrictions, but only after the CFIUS investigation process continues. And the argument is, if you have a company that is foreign-based, that does a lot of work here in the United States and is deemed to be a threat to U.S. national security, that is where the CFIUS Biden hybrid power structure can kind of step in. It's a great reminder that they've been having those conversations for so long, and yet we are still sitting here, because this was definitely an alarm that was being raised. And I will say, because I was covering Congress at the time, Senator Josh Hawley was probably the first. He was certainly the most vocal first one. He's a Republican senator from Missouri. And he was out there very early on saying this is a problem. That use of the phrase digital fentanyl has mostly been led by Congressman Mike Gallagher. He's a younger Republican out of Wisconsin. He's been very clear to say this is a big problem. We need to pay attention to it. But you also mentioned Meta. And I think it's interesting that when we've heard from people like Mark Zuckerberg, when he's shown up to Capitol Hill and he gets asked about TikTok, he says, well, at least we're a U.S. company. And I wonder how much you think that resonates with members of Congress, right? You want to criticize Meta, you want to criticize Googles of the world, all these other big tech companies. At least they could tell members of Congress, hey, we're based in the U.S. And TikTok is bringing in all these outside forces that we don't know. Is that something you think that resonates with lawmakers here in the U.S. to say, all right, we're kind of picking the lesser of two evils here to go after?
I think in a perfect world it might, JD, but I just don't think that Meta has engendered a great deal of trust amongst lawmakers, particularly when it was charged with spreading disinformation into the 2016 election in a way that was significant, at least through some analysis, in swaying the ultimate result. Of course, Meta denied that. Zuckerberg himself called the charge ridiculous. And then turned around and said, well, actually, probably that might be true, and our processes in terms of defending against it need to be improved. It's also worth remembering, JD, that the biggest data breach, if you will, didn't take place in the United States. It took place as a result of an association with a company in the United Kingdom called Cambridge Analytics. And that, as a result, sort of opened up a Pandora's box with regards to exactly what kind of data social media users are willingly giving away, and what the consequences of that are. So I think Meta had the possibility, or at least the chance, of engendering some sort of trust prior to 2016, but since then, they've been seen as more of a poster child for bad behavior, and as a result, probably less likely to get the sympathy that they might need in this case from lawmakers going forward.
All right, well, that's about going to do it for the morning's broadcast. I do have one more important question for you. The finals are set. Argentina, France. I suspect I know who you want to see win, but I will ask you directly, who do you want to see win?
Boy, now that England is out, I must say this is more of a case of sort of observation rather than support. But nonetheless, I think I would like to see Argentina take it. I would like to see Messi cap a brilliant career with the ultimate trophy, because I just think he's been such a generationally exceptional player, and it would be sad to see him leave without that ultimate accolade. But at the same time, France is playing football at a level that we just haven't seen in this generation, and they're going to be incredibly tough to break down. It's going to be a final for the ages. Someone described it as peak LeBron versus peak Jordan, and I don't think that's wrong. I think it's going to be one of the best games of the decade.
I just got chills thinking about that. See, I sort of wondered if you would go with France there, because having beaten England, sometimes you want to lose to the eventual winner. Maybe it helps kind of take off the sting a little bit. That's what a lot of sports fans say, but it is really tough, though, not to look at Messi's history and to recognize the one big one that is still vacant on his trophy shelf, and recognize your 90-plus minutes from securing it. It's going to be awesome. I'm sure we'll talk much more about that tomorrow for our Friday edition of the show. The great Martin Baccardax, thank you for helping us get smarter together on this Trading Thursday. We'll see you tomorrow. Thanks, Martin.
Thanks, JD.
All right, man. All right, folks, that's going to do it for the market open here from the floor of the New York Stock Exchange. One quick check of the markets. The Dow is down 2%. The S&P is down 2.1%. Why are you looking that way, JD? Because I don't have it in front of me, but it's up there on the big board. That's going to do it for the show. Stick with TheStreet.com for more on all of these and every other major market story that matters to you, and we will see you for tomorrow's show. See you then.